The market's cracking. Are you ready? Traders, the S&P 500 is slipping, volatility is spiking, and if you think blindly buying puts is the answer, you might be setting yourself up for failure. Options are expensive, the VIX is flashing red, and yet there's a smarter way to play the downside. Enter the put vertical spread, the way to hedge, profit, and keep the risk under control. Good morning, everyone, and welcome back to the Sensa Edge. This is your host, Zoeb, where we break down the market opportunities and how to trade them with an edge. We are breaking down how to get bearish wisely without overpaying or exposing yourself to the unlimited risk. Let's trade this smarter. Before we go in there, let me bring up my screen here. As you can see in my screen, right, let me make this bigger. The US stock fell sharply yesterday after President Trump said to expect an economic disruption from his policies. One of the notable decliner, Tesla, which was down 15%, fared the worst of the mega caps, plummeting to its biggest daily loss in 5 years. The EV stock is now trading 50% down from its 52-week high. Looking at SPX here, SPX, we're talking getting bearish wisely. We're dealing about the continued selling in the S&P. As of today, we are just shy of 10%, which marks the official correction territory. 20%, 20 is the bear market line. Given the continued downside and the fact that put buyers are late to the party, they are quite expensive already now. What's a trader to do? Well, a vertical spread, that's what? The VIX at 26 and the VVIX, which is volatility of the VIX, pushing the 120 level, red flag territory. Puts you in the full force, straight long puts are just too darn loud. That's where verticals come in. That lets you mitigate the high cost of outright option while still positioning for downside. The best part here, again, if I just open what you might say, what is particular bear put spread or call vertical spread? It's a two-leg strategy here, which is also called the bear put strategy. You are betting on a bearish. Let me go into this particular screen here. The SPX aren't cheap, especially the puts. Thanks to the put skew, downside option tend to be more expensive on an implied volume basis because institutions are always hedging. Selling a lower strike puts offset part of that cost. You might ask why? Defined risk and reward. You know exactly what you can lose. The debit you pay and the exactly what you can make. The width of the spread minus your cost. No surprises. The third good thing is the flexible expiration and strike selection. This is where you dial in your risk, longer expiration, move much more slowly, but give the trade time, shorter expiration or explosive, but don't last as long. The risk, reward, and probability. Put your nerd hat on and let's get down with some numbers. Let me bring the other screen here while we jump into this particular strategy here. Suppose you enter a 50-point wide vertical spread. All right, the screen is loading here. Again, I've already selected SensaMarket.com. I went to the option strategies, a bear put spread, also called the put vertical spread, as you can see here. You can select from the left navigation menu or anywhere from the option strategy. So this is a bearish strategy. I've selected a common expiration date here. You can change any of the expiration date. I'm like somewhere around 100 days out, somewhere around June 28th. Here, suppose it's a 50-point wide. You are buying a put at 5,000 here, and you are selling a put which is 50 points lower than the higher price. So in this case, the net code is around $5.75. The debit is $5.75 to enter. But if you are right, if it enters the bearish somewhere around 4,950, which is close to this particular strike price, you will be up for profit, which is a maximum profit somewhere around $4,420. All right, if the SPX closes lower strike, you make the full width of the spread minus what you paid. Again, the spread width is 50, entry cost, as we see, is just $5.80. The break-even is simply the long put strike minus the debit paid. You might ask, what is the probability consideration? Higher the debit, better probability, but lower the reward. Lower the debit, more reward, but lower probability. So choosing expiration matters. It's up to you. You want to choose somewhere close to the closer date for expiration or go something longer. A short-term spreads move quickly, but needs the drop to happen fast. A long-term spread is more forgiving, but costs more. A longer dated, in this case 90 plus DTE, trades are 10 to 20. Delta is a nice combination of probability, low cost, and a high risk of reward. When to use this particular put vertical spread, right? You expect a move lower, but don't want to overpay for the raw put. Implied volatility is high, making outright put expensive. You want to control this particular risk with a defined maximum loss. The structure lets you profit from the downside movement while keeping the cost under control. So if you like this particular strategy, you can go ahead and connect your Trader brokerage, and you can hit on the place order button. Let me bring back myself here. All right. That's it for today's thing. If you're looking for a structured way to play the downside, but put verticals are a great way to manage cost, control risk, and still capitalize on the bearish move. Remember, position sizing is key. If you're losing sleep over a trade, you're in too big. Next time on the Sensa Edge, we'll explore another high probability setup to keep you ahead of the market. Make sure to subscribe, leave a review, and follow us on the platform. Thank you all.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.